Paul Martin with Investor Connect. Today we're here with Lou Doctor, a serial entrepreneur and an angel investor. Lou, thank you for joining us.
Thanks very much for having me.
Oh, great. I understand you started several companies, and so you've been on, and you're also an angel investor, so you've been on both sides of the table and fundraises for early stage companies. Can you tell us a little bit about your background and what you've done just in a thumbnail so people know the background of what you've been doing?
Sure. Well, so I'm a recovering engineer by training. I went to Rensselaer Polytechnic Institute and graduated in 1979, just to calibrate how old I am. But I got involved in venture capital very early on. I started a company with my roommate from college called Raster Technologies in 1981 and got early venture capital from Venrock, the Rockefeller Family Venture Fund, at a time where I think there were only 3 or 4 venture firms in the whole country. There was Kleiner Perkins and Welsh, Carson, Anderson, and Stowe, and Venrock. And I got an early experience as a 21-year-old taking money from VCs. And since then, I've started about a dozen companies and done about the same number of direct investments in early stage startups.
So as an angel investor, what do you look for when you find a startup? For energy, looking for the space, looking for the team? What's your first thing you look for?
I mean, it's always a combination of all of the above. I tend to favor deals that are brought to me by people I know. So I don't find very many deals that come in over the transom, with blind emails or whatever, like to be that productive. So I have a good network of folks that know that I like to look at deals and send me probably 4 or 5 a week to kind of go through. So I think someone who's getting started that doesn't have such a network would probably benefit by spending some time just telling people that they'd like to look at deals and maybe participating in some of their friends' deals just to show support for that. I've made the most money on deals where I wasn't the one that originally sourced it, but it was, brought to me as it was in the formation stage and looking for that first money in. So I don't like to be the only money in at the beginning for obvious reasons. That's another red flag. So if I can't get anyone that I regularly invest with to invest with me, I usually take that as a warning sign that maybe I'm not looking at it necessarily right. And then I think it is that balance of entrepreneur, is the idea good? Is the person coachable? That's a big factor. I mean, I do feel like a lot of times folks love to get behind an entrepreneur that has this incredible confidence. It's the confidence that's almost like that magnetic part of their personality, but that is a two-edged sword. And if that confidence borders on obstinance and not coachability, then that's another one of the things that I look out for, because it is very rare that a company gets started and doesn't have to pivot a few times during its life. And if the founding team isn't open to new input or suggestions or a better way to do it than maybe the way that they thought they were going to do it, then I usually take that as a sign that my input isn't going to be highly valued, and I'm probably going to be frustrated as an outsider to the company.
So when a contact brings you a deal and they introduce it to you, what are you listening for? What piques your interest saying, yeah, I want to look at that versus, no, that's not for me? In the description that the contact gives you, what's the initial buzzword that you think really gets you involved?
I think there's a relationship between how well I know the space and how trusted the source of the deal is. So I think if it's a space I know extremely well and it's a fairly untrusted source, like someone I've never invested with before or a team I'm not familiar with or whose backgrounds I don't have any ready way to check on, then I really have to know the space well. And I think on the other end of the extreme, if it's someone that I've invested with before, made money with before, highly respect their opinion, even if it's in an area that I'm personally not that familiar with, I very often will hold my nose and write a check. Just because I kind of want to support my friends' investments. And if they've made money with me before, then I'm much more inclined to write a check without that much due diligence into their deals. There is very much a network effect, I think, in terms of trying to build your own angel network and have people that you work with well that also have roughly the same kind of investing appetite. So I think if you're a $10,000 to $50,000 player in a deal, it's going to be hard for you to cozy up to people that want to write $1 million checks. You're better off looking for people that are writing similar sized checks, just so the stage of the deal that you're seeing is going to kind of align well with that.
So you like to be the first money in, but not the only money in. How do you make sure you're not the only money in? Do you just wait till everybody is ready to sit down at the table and sign the check, or do you take personal guarantees, or how do you manage that process?
Yeah, well, I don't mind pricing the deal. So I don't mind being the first commitment in as opposed to the only money in. So I am willing to tell someone who's, let's say, trying to raise $250,000, that I like what they're doing, but I'm only good for 50 of the 250. So come back to me when you have at least another 100 or 150 raised, and I may still help like round out what you're looking for, but I'm not going to basically, let them deposit my check until they have enough other folks on the team. And then I, of course, like to talk to some of those other people that they believe are making an affirmative decision, just so I feel comfortable that co-investing together with them won't be a mistake. The whole thing is like a giant job interview, right? The entrepreneur is interviewing to the investors, and the other investors are interviewing each other, and just trying to make sure that the team kind of works well together and that there's enough alignment in the thinking that we're not going to immediately start pulling the company in multiple different directions.
So that's pretty rare that you'd like to lead the deal as far as price it. I find a lot of investors steer away from that, or they want someone else to do it. It can't be, it's a negotiation. It's not a formula. I think a lot of entrepreneurs think, well, there's just this magic formula. I plug my numbers in and everybody automatically agrees, when that's really not how it goes down. But how do you approach the pricing portion of it? What do you look for, and how do you negotiate that through with the entrepreneur to get agreement on it?
Yeah, I mean, I tend to be a lowball buyer because I kind of feel, I've done a lot of company acquisitions myself through the years, and I've sold a lot of companies to buyers at low prices, medium prices, and high prices. And by and large, the people that pay high prices for things are generally sorry and don't get the outcome they're looking for. And the people that pay low prices very often can. And I think when you're talking to an entrepreneur, the reason you can get them down off of a number that they may have stuck in their head is because they should be expecting more than just money from their early investors, right? So your early investors are a tap into the network of their group in terms of being able to potentially help the company raise more money down the road. And I like to support the companies that I'm in. So if I write a $10,000 or $25,000 check to be the first money into a company, in my mind, I'm allocating another $50,000 to $100,000, behind that, so that when the next round of financing comes, they can have a chunk of it already allocated to existing investors. And, optics are so important in investments. So I feel like the optics of having momentum for a deal, like either everybody wants to invest or nobody wants to invest. It's quite binary, right? So if you're the first one that's willing to make an investment commitment, even if you don't account for the entire round, there's a tremendous amount of value there. So another way to think about it is you could negotiate for warrants or restricted stock options or other forms of equity as like a kicker in return for being the first money in, and volunteer to take kind of an advisory role. And all of those things have the effect of lowering your effective valuation, and don't necessarily lower the valuation for everybody else that's investing if you're going to be spending time.
Right. So if you're pricing the round and doing the initial due diligence, and you kind of get in there doing that when you price the round, certainly there's value for that and you get more for your money. But aside from that, what really weighs heavily on the valuation is what really pushes it up and what doesn't do much for you. There's sales, there's team, there's IP, there's all different kinds of elements you can look at. But what do you find that's really pushing the value up, and what do you find really doesn't move the needle much for you?
Well, I tend to think of early stage ventures as having, because they have the most, they have the most risk because they have risk in so many different areas at the same time, right? They've got market risk and product development risk and management team effectiveness risk, and start listing the risks that a company that's never shipped a product or even finished a product has. And those risks are what should result in a depressed valuation for that early money. But very often entrepreneurs tend to be cocky and they don't want to suffer too much dilution. So they, basically put 3 or 4 people who are willing to quit their jobs together and tell me that they think they should have a $3 million pre-money value on the first money in. And my reaction to that is, not from me, you're not. And so, I have a healthy respect for what it takes to get to a $3 million valuation. And I don't think 3 people that haven't quit their jobs justify it. I don't care who they are. So I feel like you can be willing to push back on these terms, because most people don't. Most people just look at the investment and say yes or no without saying, well, I like what you're doing, but I wouldn't do that deal, but here's a deal I would do. So I very often go back to people with a deal I would do. And, you'd be surprised how often they try to find a way to make that work, because one of my strategies for raising money is, make sure you can get a term sheet from somebody that's leading, so that the people that don't tend to lead deals will kind of come in behind them. It's what I was just describing that I would do as the first money in. But I think that also works when you're raising a convertible note or a later financing. If you're trying to raise $1 million, you don't need $1 million investor. You need $100,000 investor that's willing to write a term sheet for $1 million financing. A lot of this is like building a foundation. Every round that you're trying to raise is like putting the little bricks in place, building the foundation, the story around why that round is going to be fully subscribed and who's in it. And it starts like brick by brick. And there's just a lot of value to be the first brick on the foundation at any round of financing and making that commitment. So you have the most leverage then. And obviously, if somebody comes to me with a deal that's already raised 950,000 of the million they're trying to raise, and I'm the last 50,000, I've got no leverage. I have to come in at whatever terms everybody else is in on.
Right, and that's some people's strategy. We used to call that the smart money strategy, which was to be the last money in, and everyone else is doing the work, and you just kind of ride the coattails of what they're doing. Of course, you have to like the terms, or you shouldn't be doing the deal to begin with, but that's just a different strategy in how you do it. But how do you get the entrepreneur to buy into the valuation at the end of the day? If they're at 3 million and you're at 1 million, how do you close that gap?
A couple ways. First of all, I think that companies would benefit by selling equity, then doing a convertible note, then selling equity again in like a 1, 2, 3 stage process. So when the company is first being formed, I'm absolutely not a fan of convertible notes. I think the interests of convertible note holders and the interests of the company diverge very quickly. So I discourage. A lot of times people will come to me and say that they're raising their first money on a convertible note, and I will talk them out. I will try to talk them out of that. So what I want to do is take an equity position, and when I'm the first money in, I'll often take common equity and not look for preferred. So I want my interest and the entrepreneur's interest to be perfectly aligned. And part of how I could get to a low valuation in that case is by not insisting on a preferred that's got preferences. I'm basically just taking common with them. Once we do that, then I think the next step may be to operate the company, get at least one of those risk factors behind you. Like if they were developing the product, then how much money do you need to finish the product? Or if you're expecting to open up certain channel partners, well, how much time is it going to take to demonstrate that those channel partners are amenable to the product and have taken it? You just want to bridge them to that first gate where they can defend a significantly higher valuation. And then I think, so I would say the 0 to 250 that someone's raising should be equity. Then I would say 250 to $1 million or 2 could be a convertible note. And then that ought to be enough to keep the company going for on the order of 18 months, so that potential of doing a priced equity round off of the convertible note seems feasible. And so I think if you do it in those 3 steps, if you want to be that first equity money in, that's why you can talk about a sub $1 million value.
And so, but you're coming in at common in that case, and that's what really sells the deal. You're not asking for preferred at that stage. Is that really the kicker?
Yeah, I mean, I describe it as I want to be a co-founder, but I want to be the one that provides some financial, kind of expertise to the company. So at that point, I am buying common equity, and I'm happy to basically have my interest in theirs completely aligned. So if the common gets wiped out in the future financing, I'm wiped out too. I would hope that wouldn't be the case, and I'd obviously be putting money in later financing. So I have some preferred very often, and I'll support a convertible note round if it's an up round from my common. And I do think that that's really important too. So I think if you do go in early, you should earmark some funds to support the follow-on financings and continue to support the company. But at the end of the day, situations where the preferreds make money and the common aren't really pleasant for me, and I don't want to be involved in them anyway. So I don't like a lot of Silicon Valley situations where you see companies with, $100 million of preferences ahead of the management team. That just seems silly to me.
Right. So aside from valuation, what else do you put into the term sheet? It seems like you're first one in writing the term sheet, and you've had experience with it. What are the other key things you like to put in there and why?
Well, once again, if I'm coming in literally as that first money in, it's almost like no term sheet. It's we're going to figure out how many shares they have and what a price per share is. I would certainly like them to consider an option pool. And if it's not already created, then it's something I would anticipate creating. So part of the also discussion of that low valuation is often these companies don't have any equity reserved for future hires, and it's good to force them to allocate that. But beyond that, I don't put really any hooks into them at all. I think of myself as an entrepreneur and as a partner to these people running the companies. And, and I want them to think of me as a true partner and not someone who's on the other side of the table when it comes time to make difficult decisions for the company. And I feel like as long as they know that most of my position is going to be common, I think it gives them comfort and a willingness to accept a lower value.
Right. Well, it sounds like you keep it simple. You align yourself with the entrepreneur on the common and an options pool as well. Those are all entrepreneur-friendly tools, and there's nothing else in there to complicate matters. I see a lot of investors start loading 1x, 2x liquidation preferences in there. We're investing founder shares, and then of course it gets to be a much more involved discussion at that point because there's more terms on the table. You can probably sell them the low valuation just by making it very simple.
Yes, and I have asked for some vesting if it's a brand new situation or if there's some reason to believe the founder may not stick it out, indefinitely. Then I have done that from time to time, but I often don't insist on that again because I feel like someone's going to walk from the situation. One of the things is that they still have to have a vision for growing the business, and if they lose confidence, then there's very little I can do. So all the hooks in the world aren't going to get you much money back in a situation where you lose the founder and the team in a really young company.
And that's a good argument for investing founders' shares, is to make sure that there's shares for those who stay behind and keep working on the business. It's very common to see companies where they've lost 20-30% of the equity because founders or early people walked out the door with it and they're off on their next thing, and we're trying to fill in the hole with what they're doing. So it sounds like that's a pretty good idea. What other tools do you put into these term sheets or make a part of that early stage negotiation?
Well, I do feel like, having a business plan of some financial model for what the entrepreneur is sort of expecting. I would say 90% of the time when I look at these early stage companies, they are not investable in their current form, meaning something more has to happen to turn them into an investable entity. And so I feel like I get paid for that work through this low valuation, and I'm willing to put financial resources and legal and other resources into just the cleanup process. And that's very often why when someone says, I'm trying to raise $250,000, I kind of look at them and say, well, why don't we just do 50,000 now and then get you in a form where you could actually raise 250, which you're not in right now. And that's also part of that idea of like, well, wouldn't you be better off to raise less now, even if it's at a lower valuation, spend that money making the company more attractive to be able to raise money at a better valuation? And I think that's the argument that gets people willing to bring money in sooner at a relatively small amount at a low valuation to sort of get me as a peer of the founder. And then again, after that, I can tell you, I absolutely do a lot of things that are not in my financial interest, but are in the long-term interest of the relationship with the entrepreneur and the team. And, sometimes I'm negotiating against myself. I'm just basically telling them, nah, don't do that. Like, that's really too investor friendly. Let's do it this way. It's better, it's better balance. Because I feel like that's the stuff that sticks in people's craws after the money comes in. And when stuff is set up in too adversarial a way, then it always just leads to that kind of we-they discussion of like, well, that's good for you, but I can't see why it's good for me. And it's like, if we're all on the same page and we all own the same security, then anything we do that's good for all of us is good for all of us.
So it sounds like part of getting a very good valuation for the investor is you're spending a fair amount of uncompensated time and effort getting the deal in shape, getting the deal led, getting the holes filled, and then making it much more available for follow-on investors. And so at some level you're paying for it, but not with dollars. You're paying for it with your time and effort there, it sounds like.
That's exactly right. And that's how I view it as well. So, that's the argument I'm making to them, is that hours I'm putting in now are uncompensated. And I never receive any like cash compensation from any of these deals. I have to make money when they make money on the equity. And as a result, I have a pretty, you can think of it as a high bar or low bar for what's my tolerance, in terms of valuation because of the work I have to do. Now, once again, if I'm a limited in a venture fund, then I'm assuming the partners that run that fund are looking at deals and doing similar things. But at the same time, if I'm going to do all the work, then I sort of need to be paid for it via a low valuation on my first investment.
Well, we're coming near the end of our time limit here. What did we not cover that we should have in this brief discussion?
Well, I maybe talk a little bit more about convertible notes because they're so popular now, but I really find them to be generally investor unfriendly instruments. I think that this whole thing with people's emotional tie to the valuation cap, and I just think that if you're not in a deal before the convertible note round, the risk-adjusted return of the convertible note is usually pretty bad because, honestly, you're getting a discount from a future valuation, but the number of companies that make it to that future valuation and successfully raise money is far lower than 80%. And very often you see these notes with a 20% discount to a future round of financing. And then the note itself means my interest as a note holder and an equity holder are divergent. And so you get these times where companies, have these notes outstanding that are burdensome for them, and they should have done equity at a lower valuation early, but they land up with note holders. Once again, I think that's an instrument that's definitely overused. There's a time and a place for it. And if the company is through enough of the risk factors to be pretty confident that another 6 to 12 months of operations is going to get them a better valuation on a priced equity round, then it may be a reasonable instrument. But once again, I see companies raising their first money with convertible notes, and often I just run away from those.
Well, very good. That's good advice and a great model for how you can get a good price on this startup. It takes a little effort, it sounds, and it's certainly valuable to the entrepreneur to have someone come in and price around, package up the deal, and get it ready for other investors, because almost all the entrepreneurs I hear talk about it being the opposite case. Nobody wants to go first. Nobody wants to price around. Nobody wants to package it up. And so it sounds like you have plenty of opportunity for what you're doing there as well.
Yeah, I see a lot of deals, and I really enjoy the work. So it's a labor of love. It's kind of a form of entrepreneurial give back. I've started a bunch of companies, sold a lot of companies, and I feel like people who are willing to go through that, make the personal sacrifice necessary, I want to get behind them if I can and I can afford it.
That's right. Well, that sounds great. Well, I appreciate your taking time and hope to hear you back again for another podcast interview in the future, but appreciate your sharing your experience with us today.
Great. Thanks a lot for having me on.